into place, Mr. Antonio.
All right, I like that. It looked like we've been doing a news broadcast.
Right. Working it out.
Well, I saw a little calendar with some topics, and I believe
Okay.
that it said, oh, wait a minute. Is that me? Who's that?
But is it giving a little echo?
It is.
Little background noise?
Yeah, it's like playing again. Anyways, types of loans. I saw that as a question.
Yep.
There's a million of them. Where would you like to start?
Well, you know what? Let's start with let's start in a place where we know
Okay.
a lot of people fall, and I would say a lot of people fall right now is they ain't got a lot of money. So if someone who did not have a lot of money, but they wanted to, get into home ownership, what loan and their credit, let's think about this. And their credit, they got an okay credit score. They're about 620.
Okay.
620.
620 FICO score,
Mm-hmm.
and not a large down payment.
Not a large down payment.
They would qualify for a conventional loan.
Yep.
So there's a misconception that in order to get a conventional loan, you have to have a 700 FICO score and a 20% down payment.
Mm-hmm.
It's just not accurate at all. 620 will qualify you for conventional loans. That comes with a 3% down payment.
Mm-hmm.
And that right there will open up your door. And then you say, well, what do I don't have the 3% down payment? You can get down payment assistance for that 3%. So it's basically it's 100% financing. The bank will give you the 3%,
Mm-hmm.
either forgivable or non, and then that has different qualifying conditions. And then they'll give you the 97% first trustee loan. So you're borrowing 97% of the money. And then that 3%, you can either borrow it, so that's a second you're going to make payments on, or it can be forgivable under certain circumstances. One of them is, you got to live in a house for 5 years.
Yeah.
Can't refinance, can't sell the home for 5 years. If you do, no harm, no foul, but they want that 3% back.
Right.
And that only seems fair, right?
Yeah. Yeah.
But if you sit in there for 5 years or more, chances are you're going to accumulate way more than 3% equity. So
Mhm.
that money, if that was free money to you. Now you just sit there and refinance into a better payment and whatever you like. And I'm sure some people would say, well, if I only have a 3% down payment, or if I'm borrowing 100%, don't I have PMI, right? Everybody's favorite word. The answer is yes and no. So you can have mortgage insurance, private mortgage insurance, in the form of a payment or built into your interest rate. Again, I always go back to what's affordable. If you can afford this payment, who cares that it has PMI built into it? Who cares that that's one of your line items? You also have property taxes and homeowners insurance. I don't see anyone saying, I don't want those.
Yeah.
They come with the requirement of owning a home. So PMI, if you don't have a large down payment, just expect it to be part of your payment or built into your interest rate. But that's your first type of loan right there. Conventional financing, 620 FICO score, 3% down.
Okay. And then are you hearing that? Is that a lot going on in the background?
No, we can't hear.
No. Okay, good. Okay, so with the conventional loan, I said, you cleared up one misconception. People thinking that you have to put the 20% down.
Correct.
Or that you had to be, the credit score would have to be at like a 7, like you need a really, really high credit score. So let's talk about, I'm trying to think, can we dive deeper any deeper into the conventional? And I think you were pretty clear on it. You know what? Let's talk about this. And I know it's going into a little bit into like payment, down payment assistance or whatever. Is there any difference in, say, Georgia Dream and any other down payment assistance program? I mean, of course, there's different things, but yes, down payment is down payment, though.
Down payment is down payment, right? The money to get in the house is the money to get in the house.
Right.
So essentially, there's different caveats to every type of down payment assistance or home buyer program. California, Cal Heifer wrote out a program that was only good for California, where the government was giving you 20%. And that was ready for a lot of people. They're like, what, 20%? I don't have PMI. Okay, they give you the 20% down. You don't have the PMI, but that was a catch because they wanted that 20% back. See, you want to pay back 3% or do you want to pay back 20%?
Yeah.
And so people really had to do some research there and think, okay, well, what is my payment going to be if I only take the 3% and only have to give back the 3% versus if I take the full 20, that puts me into a different loan because now I'm only borrowing 80. I don't have mortgage insurance, but when it's time to refinance or sell this house, I've got to give back that 20%, and they wanted 20% of your equity.
Yep.
That's rough.
That's really rough.
That's rough. And so with Georgia Dream, I don't know all of the nuances behind Georgia Dream. What I do know is they will give you the 3% down, or actually that's an FHA program. So they will give you the 3.5% down, and then they will give you up to $4,500 for your closing costs. Well, almost every program that will give you the 3% or the 3.5%, you can, for a lack of better terminology, manipulate the rate to include that $4,500 to help you with your closing costs also. So essentially you can borrow 103 to up to 105% of the purchase price. And the thought process is that 3% or 5% would be the money you're using for your closing costs, right? Because closing costs is not down payment. Closing costs is all the other fees associated with getting into the home. Now with those, you don't get that money if you don't use it all. It goes back to the government, right? You can have it, you got to use it all on the fees and closing costs. And then if it's something left, then it pays down the principal, goes back down. And so you're not borrowing it. You're not borrowing it anyways. And they're not going to gift it to you to walk away from closing with extra money in your pocket. That's just not going to happen.
Okay. What about, you just made me think about like if someone was to do a loan and they needed some repairs, they needed to do some repairs in the home. So say if they, okay, go ahead.
Yeah. That's a touchy subject, right? And really that comes down to the wording on the contract.
Yes.
So let's say they want some new carpets, some new flooring, different appliances, something's wrong, not inspection-wise with the roof, like it passes, but they say, maybe I want a new roof. That money can be given by the seller as what they call seller credit or seller concessions, but the wording needs to be very different in there, right? You don't want that contract to say this money is given for repairs, because now the lender is going to say, cool, as soon as those repairs are done, we can close escrow. Now you're stuck needing to get those repairs done ahead of time. Sellers got to actually pay for it ahead of time. Whereas if it's going to cost $5,000 to make those repairs, $3,000, whatever that number is, you can just issue that money as seller credit towards closing costs. Again, everything's just a line item. So if you pay $3,000 of my closing costs that I thought I was going to pay, then after we close escrow, I can use my $3,000 to go ahead and take care of those repairs. So that's really just, being careful how you word it. You can get that money exchanged in escrow to help you close and then take care of the repairs yourself. But if you wanted money for a home to help you with the repairs, there's different type of loan for that.
Mhm.
So the most common loan for that is an FHA loan. It's called a 203K, a rehab loan.
Okay.
You basically will look at a subject property, say, I want that subject property, but I want new windows, I want new doors, I want new flooring. I want to go to town on this house before I move in. So then when that loan closes, you get the purchase money to pay off the seller. Realtors get there, everything's done. And then that extra portion sits in an escrow account, and a contractor will get that money out of there.
I'm
and start
sorry,
making
say-
those repairs.
Who has to do it?
A contractor, a licensed real individual will be able to.
So
withdraw those
Antonio,
funds.
so what you're telling me is, so you're not gonna be, is there any loan out there where I can purchase a FHA home and then I could go in, you're gonna put this money in an account for me, and then I can go in and put in the windows, do the floors myself, you
Not
know?
legally. Not legally.
Just want you to clear that up,
Well,
because
no, it's not legal. And if an underwriter found out about it, it'd be a deal dead in the water.
yeah,
Are there ways around it? I'm sure there are. Do people own construction companies?
mhm,
Yeah, but if we find out you own it, your construction company can't be the one to do the work.
yeah,
Now, could you hire this general contractor, and after you closed, that general contractor sublet your company? Not if we know about it, but if it happened after you closed, I mean, who knows? But can you close escrow on your own, have $10,000, $15,000 sitting over here in that holdback account for those repairs, and you go over there and get that money and start making repairs yourself, going to Home Depot and whatnot? No.
okay. Just wanted to clear that up. That's a
You're not allowed to
misconception.
do
You know, sometimes I'll go into a property and you're looking at it with a client and they'll say, my husband do floors. And I say, well, I think it don't work like that. He might do floors. And if you don't need the money, if you don't need, your finance company or mortgage company to pay for the floors, and you go in there and you just do them yourself, then that's one thing. But
Yeah.
if you're getting money, if they're giving you an additional loan for it, then they want to make sure that you have a licensed contractor on it.
Correct. There's a different type of appraisal that goes along with that and everything. So an appraiser can look at some plans and spec sheets and then speculate the value after repairs. A HUD inspector goes out and makes sure that each part of the process is being done before they release the next portion of money. It's still a great way to get into a home with little money out of your own pocket to make those repairs. And that's actually one of the best loans around, is a 203K, the rehab loan, because essentially what you're doing is borrowing money to buy the price at its current value.
Yep.
And get the repair money to make it worth it, like one of the best houses in the neighborhood. And so as soon as those repairs are done, you've got all that equity.
Yeah.
Right then and right there. Like, that equity is yours, because I'm buying subject property for $400,000. Once these repairs are done, the appraiser has said it's going to be worth $500,000, but I only need about $30,000 to make the repair. So I'm buying for $430,000. And as soon as I'm done, I have a $500,000 home. That's a winning situation.
That's a winning. That's a winning situation.
Yes. Yeah. Like-minded, you can actually do the same thing, same process on just what we call a fix and flip loan. So this is what we call a non-QM loan. QM stands for a qualified mortgage, right? So back in the days, we would call it a subprime loan. Okay. Now, subprime doesn't mean terrible credit or below market. It just means it's QM, non-QM just means it's not a qualified mortgage. It's not being underwritten by Fannie Mae, Freddie Mac guidelines. And so it's really more investor savvy. The bank wants to look at it from a different point of view. And what they'll give you money for fix and flips all day long. But your loan of values are going to be different. You're not going to get away with that 3% down or 3.5% down. You got to come in with some skin in the game.
You got to have some money.
20%. Yeah. And depending on your experience, you get all the way, you might be able to get away with a 10% down payment. Generally speaking, newcomers, first-time investors, you want to put 15 to 20% of that money aside. A lot of banks will do it at 25 because of the riskiness, but basically you can look at a home that is tore all the way up and say, well, I'm going to rehab it and fix it. I'm going to rehab it and flip it. I'm going to take that house. I'm going to make it look like the best house on the block. And then I'm going to sell it immediately. And that is a different type of loan. And it's called a fix and flip. And the investor knows what your intentions are. And so they will lend you the money to purchase the home and do the complete rehab, knowing that you're going to exit out of that home in the next, 6 months or 6 months, a year. Typically, you'll be done with that project in that sort of timeline or
Okay. Look, I had to go get me some water. I was in here about had started coughing there. I was like, wait a minute, hold up now.
Water in a wine glass, that's the best water there is.
Girl, look, honey, it tastes better when it's in a wine glass to me.
So we got fix and flip loans. We also have rehab loans for short-term rental. So you can get a loan to rehab a property and hold it as an Airbnb or Verbo, whatever your platform is. So you can get the money to buy the house, rehab it, furnish it, and get it all the way decked out with the intention of it's going to be a Airbnb property. It's going to be a short-term rental property. There's loans for that. Okay. And those are treated very differently. And this is a conversation I had with someone a while back, and it kind of applies to different loan programs, but you can be homeless without a job and qualify for this loan.
Oh, yeah. Okay, wait a minute, hold up. So you can be
homeless, no job, not one single source of income. And really, you don't have to have the best credit, but the better credit, the better rate. Now, you're not going to get this loan with a 400 or 500 FICO. You're going to need to be in the 660 range, 640, 660 or higher. Okay. And you can get a DSCR loan. And what that is a loan where the investor strictly looks at the property's ability to pay its own mortgage. So again, this comes by way of an appraisal. And they say, if this property was existing in good shape, could it rent for market value? And is that market value enough to cover the mortgage payment? Okay. And if that market value rent is enough to cover the mortgage payment, that's only questions asked. Bring in your down payment and we're going to close.
So with a program like that, what does the down payment look like? And I know you said they don't have to have a job.
20,
but what does that really work? Okay, 25%. If you're experienced, you can get away with 15, and experience means you can prove that you've done this before. Okay. So it's really that simple. Usually they want something in the last year. So not 5 years ago, I flipped a house. Yeah, doesn't count. I flipped a house last year. I have 2 Airbnb properties. Recent stuff, you can get away with a less down payment. And you say, well, if I don't have a job and I'm homeless, where am I going to get this down payment from? You got to be smart. You got to go out and sell this to some friends and family and some people that, are real estate investors on the side, people that use their money to make money and say, I've come across a gem. I've come across a property that's 30, 40% under market value because it needs repairs. I can get us the money to bring it up to code. And we're going to net X number of dollars off of that. And I need the money. Yeah. And get it from 2 or 3 people, and you're in the game. So the mortgage company doesn't look at, how whenever you borrow, say if you had a traditional like FHA or conventional loan, they want to know where the money come from, right? Like if you couldn't just go get it from under your mattress and show up at the table. What does that look like with this type of loan?
Same kind of paper trail, but the money can come from outside sources. It just needs to be documented, right? And so even if you have to put partner A and partner B on the purchase contract with you so that we can justify where that money is coming from, that's okay. You can even form an LLC. You can form an LLC, corporation, partnership, and close under the LLC. And then everyone who's got money involved can be part of that LLC. And then the person doing the loan would be the managing partner. So everybody don't have to, too many chiefs in the hut.
Right. Decision maker, right. Okay.
Yep. So
Gotcha.
you got one decision maker. He's the operating partner. Everyone else that has contributed some money towards the close, they're part of the partnership, and you can go that route.
Yeah. Okay. I'm trying to think what else. What about, so we tapped on, you did say what type of credit score they needed. You said a 640?
640 or better for that. Okay. And usually, there's this thing that we often look at on the lending side. It's called a matrix. Every loan program has a spreadsheet that says what you can get for what. So for example, if the maximum loan to value is, let's call it 80%, someone will give you 80% of the money. It's going to say, well, that's for the people with a 700 FICO score. Mm-hmm. And then under that, you're going to have a 680 FICO score. And they're going to say, well, your maximum loan of value is only going to be 75. And under that, you got a 620 FICO. And they say, well, we're only going to give you 50% of the money. It's amount of risk. So looking at a matrix will kind of outline what your score will get you. Higher the score, the better the rate, and the more money they'll give you as far as loan to value is concerned.
Okay, so and I'm trying not to dig too much in like different scenarios because it depends on credit score, DTI, all of the so many other things, so many other factors. Let's go back to FHA just for a second, and then we can move on to USDA. So with FHA, credit score needs to be what?
5, well, depends on what you're trying to do. If you're trying to purchase a home with maximum financing, you need to have a 580 FICO score or better.
Okay.
Now, if you've got some skin in the game, you can go in there with a 500 FICO score. You got to have some money.
Yeah. Okay. So I just wanted to kind of clear that up just a little bit. All right. Yeah, so what about?
Let me touch on that 1 second. And the reason for that is there's different type of underwriting. A 580 FICO score will get you qualified for automated underwriting, meaning if the computer model says it's approved and eligible to be bought by FHA, no one can argue with that. They got to just ask you for the paperwork, verify everything, you're in the house. With a lesser FICO score, we can get like approved refer or refer eligible. Refer eligible basically means that it's eligible, but we're going to need to refer this out to manual underwriting. And when you get manual underwriting, this is exactly what it sounds like. It's a human decision. It's a human going through the file, trying to line up everything, make sure it all makes sense. And then if it makes sense, that loan will get funded also. But generally speaking, you drop below that 580. And if you move into the manual underwriting arena, you're going to need some money, some skin in the game. And you're not going to get max financing at that FICO score.
Okay. USDA.
This one's funny because a lot of people don't even know about USDA, United States Department of Agriculture, right? So USDA, same people stamping meat in the grocery store. It is. They fund loans. They fund loans. You need to live in a rural area, or the property needs to be in a rural area. And there's actually very easy. Let me see if I can pull it up real quick and share the link. So USDA Rural Development. If you go to the USDA website, it's a simple Google search. You can actually find a map on there. And the map will tell you if the property that you're looking at is in the rural area or not. The funny thing is, a lot of homes qualify for it, but people don't know. Like your homes in the inner city aren't going to qualify.
Right. You're not going to downtown Atlanta.
Nope, that's not
USDA.
it. That's not it.
Right.
But the unincorporated counties of Atlanta, most of those would be considered in the rural area, and those homes would qualify. USDA is very, I wouldn't say they're user friendly or consumer friendly, but they're consumer aggressive, meaning you can get 100% finance.
Right.
Right. You can get all the money. You can get money for your closing costs, down payment. You can get into a USDA home for very little money out of your pocket. I don't even want to say downside, it takes longer to close a USDA loan.
Yeah.
It has to be underwritten twice. So it's going to go through the normal underwriting process in-house with a lender. And then once it's passed and everything's approved and it's got its final clear to close, well, not the final clear to close, but the final approval, then that file then goes out to the USDA to be underwritten again. And that's basically going to add, another 10 to 15 days to your process. They'll finish it, finalize it, send it back for the clear to close, and then it just picks right back up where it left off.
But I think the good thing about USDA is for a person that is okay with being outside of the city, outside of the hustle and bustle of life, But at the same time, I know I'm pretty close to USD areas here in the Covington area. And, when you think about someone who don't have a lot of money to put down, they have 45 to 50 days, whatever it is, to go through the loan process and everything. And because your credit score with the USDA is I can't remember now.
You could, overlays is a big thing, but on a USDA loan, you get away with a 620 FICO score. You can be down even in the 600 range.
Okay.
Again, when your score changes, loan to value will change.
Right.
But your USDA loans will go all the way down to a 620 FICO score as well.
Okay. I don't know why I was thinking it was like 600, but so you do need a little higher credit score than the 580 for the USDA.
You can get away with a 600, but you can get away with a 600. 620, you'll get a slightly better rate.
Okay.
But you can qualify for USDA loan with a 600 FICO score. And that's going to be like for purchase or a rate and term refi. If you own a home and you want to refinance into a better rate for USDA, then you're going to have a 620 FICO score.
Okay. Okay.
And those are generally your 30-year loans, owner occupied, primary residence, can't buy an investment property on a USDA loan. And let me clear up that conversation. Let's say you buy a home and you decide to rent it out later. You don't have to contact the USDA and be like, yo, I got owner occupied financing on this house a while back, but now I'm moving and I'm going to rent the house out. You don't have to do that. Right? It's okay. It's okay.
All right, I'm doing things in the background here. All right. Okay, so we went over conventional, we went over FHA, USDA, the two, what is it? What was the other loan we talked about?
The 203K, which is an FHA product.
Okay.
And then your non-QM loan of fix and flip. The rehab loan, or DSCR, which stands for debt service calculation ratio. Now with that one, I think it's important for people to, there is no debt to income ratio involved. Okay. And that's what a lot of people think is a roadblock for owning an investment property is, oh, I'm not going to qualify. I already have a car note. I got student loans. I've got my own mortgage. There's no way I can qualify for this added mortgage. With a debt service calculation ratio loan, a DSCR loan, you don't qualify off of debt to income. Your income is never even put on the application. It's whether or not the property has the ability to pay its own mortgage. And that is based off of the appraisal, not your speculation. And if that property can, then that's what qualifies you. It's not debt to income ratio.
Okay. What would you say as far as properties, what would not qualify for something like that?
What would not qualify for DSCR?
Mm-hmm.
Oh, to be honest,
Like, will a mobile home qualify for it?
mobile home will not. Mobile home
Okay.
park would.
Mobile home park will,
Yeah, you
but
can
a
buy the whole park.
standalone
Can't buy the mobile
mobile
home.
home
Correct.
house will not. Okay.
Correct.
Okay.
Yep. Yeah.
All right.
But DSCR, you can use it to purchase a gas station, to purchase a book of business. You can purchase someone else's business.
Mm-hmm.
You can use it to purchase multi-units, so not your 1 through 4 residential, but 5 properties or more. A little strip mall, a shopping center, a church. Most people don't want to land on no churches because they don't want to, have to foreclose on Jesus. So, but those DSCR lenders
Foreclose on Jesus.
Hey, say, man, we don't want to serve the foreclosure notice to the man of God. But a lot of the DSCR lenders, they'll even take on that type of loan. Airbnbs, your real bed and breakfast institutions, small hotels, boutique hotels, like all of those things qualify in the DSCR realm.
Okay. Okay. The only thing, mobile homes.
Yeah, you're not gonna buy a mobile
But
home.
a mobile home park, you can.
Mobile home park, you can buy that.
Okay. Okay. Because I've been talking to a lot of people now that, of course, with home prices and everything is kind of, they've kind of went up there. You're not gonna find a ranch style home for around $30,000 to $70,000. It's just those days are gone. So now the thing now is I hear a lot of people say, oh, I'm gonna buy some land and get a mobile home, and then they can use it as a separate property and rent it out and things of that sort. So just wanted to clear.
Let's back up to the land purchase, right?
Okay.
Another type of loan is a OTC, a one-time close. A one-time close will give you the money to purchase land and do the construction. And the beauty of it being a one-time close, this is different than your normal construction loan, all right? A normal construction loan, you need to either own the property or have enough equity in the property that you can then leverage the property to start your construction process and then borrow some money to finish the construction and then borrow a takeout loan to finish that off. I'm done with the construction, so let me pay off that loan, and this is going to be my permanent financing now. A one-time close is money to acquire the land and the construction costs up front, all in one loan, one closing, one escrow process, one interest rate, one fixed payment for 30 years.
Okay.
And believe it or not, it works with the same guidelines depending on who you use to fund it. So it can go conventional, it can go VA, and it can go FHA. You can basically, whatever those loan limits are, you can qualify to make that happen. VA is the most lenient with debt to income ratio, with loan amounts. So a veteran could buy a piece of land and build a house quicker than getting a piece of land and putting a mobile home on it. And mobile homes don't qualify. You can't buy land and buy a mobile home. You could do a manufactured home. You can do a modular home. You can do now, some of these lenders are even opening it up to container homes. So you can buy the land and a container home. Oh, I see Miss Jones got a lot going on over there with the construction.
I'm talking to other people too.
We need some elevator music in the background.
I'm sorry.
No, it's okay.
All right, so wait a minute. Let's stay on mobile and modular when it comes to financing and purchasing and everything. So say if someone owned a mobile home and they wanted to take out a HELOC on it. Can you do that on a mobile home?
Yeah, that's a question I don't know the answer to, but I don't think you can.
Okay.
I think you could refinance it and borrow the new appreciated value and take that in cash. I don't know of any equity lines for mobile homes.
Okay.
Manufactured, yes.
Okay.
I personally don't know of any HELOCs for a mobile home.
Okay.
Financing a mobile home is more like financing a car
Yeah.
than it is like financing a house.
Yeah.
No
Yeah.
30-year loans, you know, you max out maybe at 25.
Mm-hmm.
Rates are higher. I've had clients look at mobile homes in the past, and I convince them to just go buy a townhome or something with a better footprint, because by the time you factor in it's a 25-year mortgage with a higher rate than a 30-year mortgage.
Yep.
Stretched out over a longer time, your payment is pretty much up there again anyways. You're still going to have property tax.
Yep.
You're still going to have homeowners insurance. You're still going to have this space rent fee for being in the mobile home park if you don't own your own land. So you bring all those things together, your payment is pretty close to a mortgage payment anyway. So why not just bite the bullet and get a home?
Right. And I think for some people, it's because they think that purchasing a home or building a home is, you know, with a mobile home is one of those things that, you know, you probably can get in it quicker. I don't know if you could. I don't think though. I mean, I haven't looked in. I talked to someone not long ago about purchasing they wanted to get a mobile home, but they couldn't get financing for it though.
It's difficult.
It's a difficult thing and they wanted, you know, like $10,000 down on. I was like, you could go and, you know, you literally could get, I don't want to say something better because I'm not talking down on a mobile home, a modular home or whatever, but when you compare apples to apples to it, and the money that you have to put in it and the way it depreciates, it's a little different to me. So that I just thought about, I was talking to a client and she was talking about a mobile home and she was trying to come on the outskirts, which is, you know, so that's what made me bring that up. All right. So let's think about what else. Trying to think what else we could, when it comes to the loan. Okay, let's talk about this. Can you think of any other loans that we can talk about? Because then I want us to talk about, because I don't know if we tacked on this last week, the true difference in your pre-approval and your pre-qualification.
Okay. First is the other loan that I can think about. I don't think we really talked much about a VA loan.
Yeah, there you go.
So a VA loan. Veterans.
Oh, yes.
My favorite clients for so many reasons. I had 3 generations of men that served in my family, number one. But veterans deserve a home. Like, they barely get any health care. So
yeah,
they deserve a home. And they deserve a home for little to no money out of their pocket, and they deserve the best interest rates going. And that's what veteran loans come with.
Okay.
Apples for apples across the board all day long. Your VA loans are going to have the most competitive rate. They're going to have the highest loan limits. They're going to have the highest acceptance to the debt to income ratio. So you can go way over 50% with a VA loan.
Right.
I closed VA loans in the 60s before. And again, like you said, well, why would you want to qualify for a loan? You're 60% debt to income ratio. You don't have no money left. Well, because that's what you have to qualify with on paper. You know, if you're a handyman and you're making all these other moves, you got somebody else living with you, and you know that the bills can be paid, but all you can put on paper is that sort of DTI, then that's one thing. But veteran loans are underwritten in-house again, automated underwriting. And then with a lower VA score and credit challenge, you can then move into manual underwriting there also, so you can get away with a lot on the VA loan. I did 100% financing for a guy with like, man, this dude had, I'm pretty sure he had a 510, 515. He was nowhere near 600. He had a 500 something FICO score. And you can see his credit, why he had that kind of FICO score. This guy was self-employed and didn't have a business license, kind of self-employed either. But he was documenting his income.
Right.
You could see it all in bank accounts. You could look at canceled checks. This guy qualified for 100% financing. Now, he was really, really blessed. This is a different scenario where he actually moved into a home with a bunch of equity because he had been renting it out for years. And the owner said, I'd sell it to you if you can qualify. And he thought he couldn't until we met. And I said, oh, we can get you qualified. Went manual underwriting on a VA loan, put this guy in the house for 100% financing. So VA loans are really good. If you have any kind of service rated disability tied to the VA loan, you'll be exempt from their VA fee. It's like a funding fee, similar to PMI, very similar to the upfront PMI, but there is no monthly PMI on a VA loan. There really is no upfront PMI. There is a funding fee that goes to the Veterans Administration. Your loan origination on VA loans is capped at 1%. So you will never pay more than 1% of the price of the home in all of your origination fees. So origination fees would be like underwriting, appraisal, loan origination. If it's at 1% or less, that's saving you money. And generally, every VA loan that I've closed, they didn't even come out of money, out of pocket at all. They might have fronted the cost of the appraisal up front, but then that got given back by the seller. Those loans are really some of the best loans for multiple reasons, but VAs, and they also qualify for that one-time construction loan I was talking about earlier.
Okay. Now, when you say 100%, I mean, that they qualify and, you know, the funding fee and everything else, what does that, because someone who just went in the military, they've only been in the military, say 2 years, and they're still in the military, would they qualify for that? Or does it have a certain amount of time limit in, or service time or anything like that?
Chances are, if they're still active military, they're gonna not be exempt from the funding fee, but they will be qualified for the VA. So the VA requirements, they're a little different. And sometimes you will get less entitlement than max entitlement, depending on how long you've been enlisted. But if you've done training, if you've done combat time training or combat time deployment, you qualify for the max benefits on your VA entitlement. And max entitlement will get you 100% financing. Another misbelief is that you can only use a VA certificate once. That's not true. You can use it multiple times, but you can't use it on multiple homes at the same time at 100%. So let's say you only use some of your entitlement because you have some down payment money. Then you want another house as a second home, or as a, you know, you're going to rent out this house and move across the country, but you don't want to get rid of that loan. You can leave that loan there and go over here and use the rest of your entitlement. It becomes this very calculated math equation as to how much more entitlement you can use. But you're not going to be able to get 100% financing twice unless you pay off the old VA loan, refinance it, whatever. If you free up that one, then you can use 100% again. And once you're in a VA loan, anytime that the rates go lower, and it's at least got to be at least 0.5% lower than where you're currently at, you can do what's called a VA streamline. It's called an IRRL, I-R-R-L. Actually, 3 R's. IRRRL, an interest rate reduction refinance loan. Very little paperwork. If the VA rate is lower than what you have by 0.5% or more, you qualify for the IRRL. You literally put your name on the application, sign the application, and we'll get you hooked up with the lower rate because you already qualify.
IRRL will set you free.
IRRL will set you free. You're already in the house. You're already making the payments. You're already on the VA loan. Rates are cheaper. You're entitled to that lower rate with very little paperwork. All right. And now back to your other question, the difference between pre-qualification versus pre-approval. The true difference on those is someone's opinion based off of what they've seen, pre-qualified, versus underwritten by the AUS system, or a what we call TBD, to be determined, where we actually take your entire file, and the only thing missing here is a purchase contract and an appraisal, but we put that in front of an underwriter, and they qualify you on the speculation that, yeah, as long as the house is $500,000 or whatever the loan amount is, whatever that part of it is, that file can be underwritten and you're approved. That's pre-approved. You just need a house. you just need a purchase contract. If you haven't completed an application, if you haven't shown your assets, if you haven't provided a copy of your ID and social security card or passport, if you haven't verified funds, you're not pre-approved. You might be able to get the approval, but you just are not truly pre-approved. A pre-approval,
scary.
Yeah, a pre-approval should come with an AUS number, an automated underwriting system number, saying here is my case file. I have been underwritten. An underwriter has seen all of this information and has given me the approved, eligible, and I just need a property. That's a true pre-approval. And that will get you closed in like 12 to 15 days once you have a house. Pre-qualified.
And that would prevent you from losing money.
Oh, absolutely. Absolutely.
You know, that it just amazed me sometimes that, and I even see it like on some of my properties where people will send over pre-qualification or I don't know what kind of pre-approval it might be, but you could tell. I mean, even whenever I talk to the, you know, if I call and find out, you know, just kind of find out exactly how qualified they are, and they be like, oh, well, they still need to send in this and that. I'm like, here it is, you're about to pay earnest money. If we accept your offer, you're going to have to get an inspection and you get an appraisal, and
it's money out of your pocket.
It's money out of your pocket, and you don't even know if you're going to be able to close on this thing.
Yeah.
Like that's just scary to me.
Yeah. You know, it does everyone a benefit to do the due diligence up front.
Yeah.
The due diligence up front will get you where you need to be. You know, without names and details, there's a mutual client that we have that, you know, switched jobs. And even though the new job might say you're making $75,000 a year, well, we're not going to count that because you haven't had that job for 2 years. And so my job as your loan officer is to get those numbers in front of the underwriter to let the underwriter do a calculation and tell me what we can really count as the income. And then we go forward with working backwards, right? Okay, here's your income. Here's your max DTI based off of these different loan amounts. This is what you can qualify for. So there's a lot that goes into it, but until an underwriter sees it, at a bare minimum, you run it through AUS with verified information, not just the application. You want to run it through AUS with verified information. That's your true pre-approval.
Which that's what you want.
Absolutely.
That's what you want.
Fixed rate loans, adjustable loans, bridge loans, reverse loans, construction loans. Fixed rate loan, very simple. It's fixed. All right. Interest rate never changes. People think that those are only 15 and 30-year loans. It's not true. You can go anywhere from 8 years to 40. That's the term on fixed loans. You can have an 8-year fixed, 9-year, 10-year, all the way up to 40 years fixed. Those are the different fixed rate loans. You get one rate up front. That's your payment. Your payment remains the same. Your interest rate remains the same for the life of the loan. Maybe your last 1 or 2 payments might be different because there's the way it calculates amortization. An adjustable rate loan. People are scared of adjustable rate loans. They got a bad rap back in like 2005 to 2008. But I'll tell you right now, adjustable rate loans are not a bad way to go, especially for someone who knows they're only going to be in the house for X number of years.
Yeah.
Okay. So let's talk about that. Most people refinance their house every 3 to 5 years. Most people, until they find their forever home, typically will find a new house every 5 to 7 years. So if a 30-year fixed rate mortgage is at, let's say 6%, but the 5-year fixed rate mortgage is at 5%, why would you not go with the 5? It's only because it's an adjustable. It's not an adjustable. Not every single day and every single week and every single month. It will adjust after a certain fixed term. And that's what a lot of people don't know. You can get a adjustable rate mortgage that is fixed for 3 years, 5 years, 7 years, or 10 years. And if it's fixed for that period of time, and that period of time serves your need, and it has a lower rate than the 30-year, then you jump in it. And then the fear there would be like, well, what if after year 4, when it adjusts, the rate is higher? Well, get refinanced back into another adjustable rate. Literally, that's what you do, because those rates trail lower than fixed rates. Always. Adjustables are always lower until they adjust. But when they adjust, right, here's your fixed rate mortgage, here's your adjustable, they're doing their thing, and then now this hits an adjustment cycle, and they add to it the 2% that is going to adjust automatically, and now it's here, and the fixed rate is here. Well, then refinance into the fixed rate. But if fixed rates went up, the adjustable is still going to be below that. So refinance into another adjustable.
Yeah.
Again, it just takes conversations to see what your plan is and what's going on. Bridge loans. Bridge loans are something meant for short-term financing to just really bridge the gap between what you need and what you have. So a lot of bridge loans happen when someone's selling their home but haven't sold it yet. But they find their next dream home and they're ready to move and don't have time to wait around for an offer or to close escrow here. So you can get a bridge loan. I own this house with X number of dollars in equity. I don't feel like doing an equity line or taking out a second, none of those things. I want to go qualify for this house, but I need that huge down payment to get me in here that I would have if my house closed. So I can take a bridge loan, which is short-term financing. It's still amortized over 30 years, but on paper, it says you're going to pay this money back in 1 year, 2 years, 3 years, 5 years, whatever that term might be. Generally, that money is paid back within the year anyways, because you're going to close your house. But bridge loans are very good for people who will need to move on fast. And they're very good for real estate investors that are just trying to move money around to get into the next property until the other one closes. Reverse mortgages are, it's not an equity line per se, but what it is, let's say you have $300,000 in equity and you really needed more income. This is for someone who needs income. This is generally for older.
I was about to say, I think when I think about reverse mortgages, I think about older people.
Yeah, these are for people on fixed income, living off of their Social Security, retirement, stuff of that nature, but don't have quite enough income coming in, right? And so basically you borrow against your equity in the sense that they keep paying you some of your equity every single month. Now, as they're paying you this equity, your equity is going down. Now, you're getting less and less equity in your home. And they say, well, at some point in time, they're going to take my house. That's a misconception.
Right.
Now, if you don't refinance that into some sort of permanent financing to settle that loan, then that's the same thing as a regular mortgage anyways. They're going to do the same thing regardless. But it's not intended to take your home. It's intended to give you portions of your equity. And let's just be really frank and candid here. It's intended to give you portions of your equity until you've lived your life.
Yeah.
And then your family will be responsible for that loan the same way they would be, even if it was a regular loan. So reverse mortgages do have great purposes. And a lot of people want to start living their best life in their later years, but don't have the income. That tool is for them. It will give you money every single month from your equity. Some of them give you a lump sum too. So I'll you, boom, here you go.
Take this.
Yep. But at some point in time, yeah, your living trust, your will need to account for the difference in what you owe and what that house is worth. But it's not a bad loan. And then construction loans, we touched on a little bit with one-time construction. Your normal construction loan is you've already bought the land, you already have some skin in the game with the land, and now you just need the construction money. That is money that the bank gives you in an equity account or an escrow account, and then the contractor draws from that money until the house is built. And your traditional construction loan, once the house is built, you're going to need to take out the 30-year financing now to actually pay off the construction loan and then have your normal 30-year fixed on the backside.
Right. Yeah. Okay. That was very helpful. I think we kind of tapped on several different things and cleared up some misconceptions of different, especially when I think about the conventional loan. Because I hear people always say, "Oh, I can't get a conventional loan because of the fact I need, I don't have 20% to put down."
You don't need
So
it.
I know that's one.
Don't need it.
Yeah.
Just need a 620 FICO score.
Yep. You need a good credit score, and you need a job. Let's. I know we only got a couple, like 1 minute left.
That's
I always
okay.
tap. I always tap back into like the entrepreneur world.
Mm-hmm.
With the entrepreneur who's been paying their taxes, they've been paying their taxes. They claim they said they made $100,000. They didn't write everything off. What loan type? Well, I guess that's kind of vague. That's kind of tough. You can't really, it's just, that could just go so many different ways.
Self-employed borrowers can qualify for every type of loan that there is. It's going to be the documentation that they're able to provide.
Yeah. Okay.
Yeah. If they are well established and they pay themselves via a W-2, that's just normal conventional financing, like right there. If they haven't written everything off and they have good taxable income, they qualify for conventional or FHA. Self-employment income works for VA loans as well. When you need to start getting creative, like, oh, I can only show you my bank statements. Look, you can see all the money, but don't look at my tax return. We got a loan for that too. It's called a bank statement loan.
Yeah.
There's a 1099 only loan. Independent contractors that only get 1099 money, don't want to show their tax returns. We can look at only your 1099. And believe it or not, we can wrap up on this, but you can actually qualify for an FHA loan off of written verification of employment only. And what I mean by that is we send a form directly to your employer, not to you. We send a form directly to your employer, and they fill that form out with how much you earn, and that's what we count. And that's what gets counted.
But that's not for your entrepreneur though, because
that's not for your entrepreneur.
Right,
it's like for a gig worker.
Yeah. Okay. Well, this was good.
Yes, ma'am. I'll see you again next week on Monday.
Yes, indeed. Hopefully people will put some comments down in the bottom, like underneath, to see what questions they might have. You see how to get in contact with Mr. Antonio. You can scan his little, what is that thing called? QR
code.
There you go, QR code. I'm showing my age now, huh?
The little scanny thing.
That little scanny thing. All right, I so appreciate you.
Me too. I appreciate you. I will see you around town.
All right. Talk to you later.
All right, bye-bye.
Bye.